from Marc Faber on how he sees various global asset classes panning out over the next few weeks.
Asset markets move up and down, and they go from a rising phase into a boom phase and into a collapse, and then people are gloomy, and there is a gloom and doom around, and then the markets bottom out, and then the whole process starts again. So I think as an investor, you have to realize occasionally markets are overvalued and occasionally they're undervalued. If it were possible to take interest rates into negative territory, I would be voting for that. It means that the Fed will keep interest rates below the rate of cost of living increases, essentially for as far as the eye can see. And in that environment, obviously cash and bonds are dangerous, and they have to move into asset classes like equities, commodities, real estate, art, collectibles, and so forth. Anything that essentially cannot be multiplied at the same rate as paper money, that is subject to the printing presses of Mr. Bernanke. The absolute level of interest rates doesn't tell you whether there's tightening or not. In China they increased interest rates already several times, but with inflation running at say between 8 and 10% per annum, and the deposit rate at 3.25%, money is losing its purchasing power if you keep it on deposit. So I think in the US you'll have a similar process. One day they'll increase it by 0.25%, but what does it mean? When commodity prices are going through the roof, energy prices are going up, healthcare costs are going up, insurance premiums are going up, everything is going up. Only at the Federal Reserve is there no inflation. In gold and silver terms, the Dow Jones over the last 10 years has already lost more than 80% of its value. If it were a bubble, a lot of people would have gold. The whole world would be trading gold 24 hours a day. But I don't think it's really a bubble. I think maybe gold is cheap